Hello, I'm Dave Carpenter of Altair Advisors, and I'm here with Caitlin Dixon, a senior financial planning analyst for Altair. We are going to take a big picture look at 529 college savings plans and provide some guidance on how to choose one, how to use one, and I can't think of an appropriate third rhyming word there. How not to lose one? Maybe Caitlin can. Caitlin, you've recommended and given advice on 529s for many of our clients, I know. Before we dig a little deeper, can you just briefly describe the basics of 529 plans and their benefits?
Sure. And hi, Dave. Thank you so much for having me. So, 529 plans, they're actually investment savings accounts, and they got their name from Section 529 of the Federal Tax Code. Little fun fact there. They were created to fund college tuition and other, qualified expenses, but they're super robust. As you can see on the right-hand side here, we've listed some of the big picture benefits. The accounts, they're tax advantaged. I think that's the key theme throughout this presentation and the article that we included. So when you pull the assets out to pay for college expenses, the entire withdrawal, including the growth, is tax-free. Depending on the state you live in, you could have even more benefits, such as income tax deductions. You can contribute to these plans regardless of who owns it. You can change the beneficiaries. You can accelerate annual exclusion gifts with no gift tax consequences. The benefits there are really very robust for these plans.
Okay, that's a good overview. And it seems like when it comes to saving for college, no one ever talks about any other plan than a 529.
Yeah.
So what out of all those things you've cited, what in general makes the 529 plans so beneficial?
So you're right. There are multiple options out there. We really like 529s for a lot of our clients, not all, but in a lot of situations, because these are investment savings accounts. So they do take advantage of market growth. The power of compounding is a beautiful thing. And the more time that you have, the better for the growth in your account. So you can take that birthday money, invest it in the markets, and let it grow for 5, 10, 15 years.
Okay, sorry. Now we've got pros versus cons here. Anyone who's looking at this might think, oh, well, there's a lot of negatives to this, but are these just more things to be aware of, or is there something here that really would dissuade a lot of people from investing in 529?
Sure. So there are potential downsides, of course, as there are with any investment account. We can't say there's no downsides. We want to make sure that everyone is aware of, the caveats if they're going to participate. So if you're participating in the markets, of course, you're exposed to the market risk. An account invested in stocks may have greater growth potential, but it also can be more volatile than one that's invested in a fixed allocation or even a mix of stocks and bonds. Withdrawing the money can be more complicated than, making contributions to these accounts, because we keep emphasizing qualified expenses. But keep in mind, only the earnings portion is subject to taxation and the 10% penalty if used for non-qualified withdrawals. So your contribution is never taxed or penalized. You can see on here, we also mentioned financial aid. So having a 529 can reduce the amount of need-based financial aid that a student could be eligible for, but the impact, it's very limited, and it really depends on who the owner of the account is. So it's not always that big of a deal.
All right. You mentioned, and the slide shows non-qualified versus qualified. So what expenses qualify under the plans and which ones do not? Is this obvious? Is there something in the not included list that tends to trip people up?
Yeah, so you're right. Of course, we have qualified tuition and fees, books and supplies, room and board. But as you mentioned, I think it's easier to summarize what's not included for these plans, that sometimes people call us and ask if it is included. Travel costs to and from school, health insurance, extracurricular activities. I think the biggest one we get asked about is college application fees or college prep exams. Those are not included in a qualified expense for 529s.
Okay. So now we've outlined what 529 plans are all about and told people the advantages and potential disadvantages. So Can you now share your best advice on how to approach funding them?
Sure. So, of course, college can be a large undertaking, especially if you have multiple children. So, you may want to consider contributing to your oldest child's 529. And then if they don't use it, you can roll the funds to younger siblings. Consider setting aside money every single year. And you can actually set it up as automatic transfers monthly. You can gift up to $18,000 per year in 2024 as a single filing taxpayer, or $36,000 per beneficiary as a married filing jointly taxpayer. And that's with no gift tax consequences. As your kids and grandkids get older, keep having conversations with them about the school they're interested in, or what they want to do when they grow up. And as you get a better idea, you can, of course, adjust your contributions as you develop more clarity. Again, as a reminder, anyone can contribute here. So talk to grandparents, talk to parents, aunts, uncles, etc. Maybe recommend, instead of the birthday or graduation gift, a little contribution to the college savings account.
Excellent idea. All right, time for an FAQ. I know that one of the most frequently asked questions that you get about these plans is, what happens to the money in your 529 account if the child does not go to college, or if there's unused money for any other reason?
Yeah, so I'm glad you brought this up. So if you oversave for college, it is not the end of the world. As I mentioned, these plans are very flexible, and there's a lot of alternative options if the funds don't all get used, or if your child doesn't go to school. You can use the leftover money towards vocational school or even personal interest classes. You just have to make sure that the program is connected to a student aid program at an accredited university. Some states now allow for funds to be used for tuition up to $10,000 per year for K through 12. That's not every state, so check with your state before assuming that you can, but a lot of states do offer that now. You can change the beneficiary to the 529, of the 529 to one of the current beneficiaries' relatives. So that includes spouses, aunts, uncles, cousins, nieces, nephews, etc. So there's a lot of flexibility there. And we actually have a new rule now in 2024 that allows you to roll the funds into a Roth IRA for the beneficiary. Of course, there's rules and limitations with that, so check with your advisors before moving forward. But honestly, Dave, as far as last resorts go, withdrawing the remaining money as a last resort, it's really not the worst situation in the world, since, again, the tax and 10% penalty, it's only on the growth. It's not on what you contributed. But keep in mind, you can always hold on to the account for other family members, future grandchildren. So the accounts are flexible. You do have a lot of options here.
Not a bad problem to have, if it is even a problem.
Yep.
Okay, thanks, Caitlin. I hope this look at 529 plans has been helpful for the parents and grandparents interested in funding them, as well as for the students using them. For a more in-depth look at 529s, please see the blog article in the Our Thinking section of our website. Thank you for watching.
Thank you.